Welcome back to another episode of With Sonar. I'm your host, Luke Velasquez, and it is another Wednesday here. The Wednesday after Labor Day, in fact. So hopefully you all had a great holiday weekend, enjoyed some of the time off, but it's back to work, and here we go. And of course, I'm joined by my co-host, Kyle Taylor. Kyle, thanks for joining. Did you have a good Labor Day?
You almost walked right over that. It's like I wasn't even here. We were just going to go right on to the show.
I thought about not mentioning it and just having a 30-minute dialogue with myself and our viewers and just not even mentioning
Correct.
You, but
on this show today, we're going to talk about X, Y, and Z. Oh, yeah, Kyle's here.
I'm Luke Velasquez, the only host.
Sometimes it's like that.
Yeah,
but no, it was a great 3-day weekend. I had some family in town. I had my nephew, 16 months old.
Right
so
on.
that
He's
was
saying some words.
He's talking his own language. I don't know what he's saying, but
the words.
I go
with
with
not necessarily the same ones
yeah,
you use.
that guy is just a chatterbox.
Yeah.
Went to the aquarium.
The aquarium's nice here in Chattanooga.
They didn't know they had 2 separate aquariums. It's actually
they got the freshwater and then the saltwater. For those that don't know, our aquarium here is called the Tennessee Aquarium. It's in Chattanooga, Tennessee. We've got one display. It's all like freshwater type stuff, like river fish and animals, and then you go over to the saltwater side, and you get all the typical saltwater stuff: your sharks, turtles, all that stuff. It's great.
Yeah. So
you go swimming?
I did not. Unfortunately, they wouldn't allow me. But if I did, I probably just would have to keep my mask on. I would end up like waterboarding myself while I was in the tank.
You'd probably want to keep a scuba mask on.
Yeah. No, but that was a great weekend. So
Good.
Was very restful. And
nice.
How about yourself?
Yeah, can't complain. Didn't really do a whole lot. I've got the kiddos now, so we're just trying to juggle that. Now we've got a 6-week-old who has joined our family. We did a little cookout with some friends.
It was a beautiful weekend.
It was beautiful. In the morning, it was like in the 60s or something. We haven't seen that in
we
a while.
We have the people over on the West Coast that are having fires, 3-digit degrees in temperatures, and then we're over here in Tennessee, and it was 60 degrees when we woke up.
It's like 60 to 80 throughout the entire
Almost
day.
felt like fall.
It did almost feel like fall.
And since it felt like fall, my wife decided that we need to get all the fall stuff. So what do? Some Hobby Lobby and and spent a ton of money on that. But we're not here to talk about my mistakes. We're here to talk about the freight industry. What do we got going on coming off of just like any holiday weekend?
Yeah.
We're going to have a big drop in volumes. We're going to have a big extension in tender lead times. And we're going to see, actually it's kind of unsure how we would see what tender rejections we're going to do. End up, reefer rejections came down a little bit, but volume or rejections on van had continued to increase, which is obviously really indicative of continuation of price increase or rate per mile increase on that spot market.
Yeah, and a lot of tightening on those routing guides, especially as shippers try to we're putting in some of those last minute orders or tenders just to get that freight moved before the holiday. There's been a dip. We'll probably see some sort of recovery in a few days. This year's Labor Day was much later than normal.
Yes, so, almost by like a whole week.
Almost by a whole week, yeah. By this time last year, I think volumes had already picked back up after Labor Day, but right now, they're still only on like their second or third day down.
Right, and if you have the seasonality volume chart, go ahead and get that thing up there. We can really see that and throw that thing on a seasonality view.
All right, let's go ahead and throw this on the chart if we can. There we go.
Throw that on a full view for our people at home.
Full view?
Yeah.
We're looking at it for like the last 4 months.
Well, full view shows when the uptick comes back up.
Oh, okay.
A little bickering here from Luke and I just makes you feel like
this is why
this is real.
This is why I thought about having a monologue with myself. I always win the arguments when I argue with myself.
Exactly.
No, for everything, what Kyle is saying here is absolutely correct. So this view that we're looking at here, notice the blue line for a minute. The blue line is the truckload volume level in the United States. If you've ever watched any of our shows where we show Sonar, this should look very familiar to you. This is that volume level there is in blue. That's updated daily. So you see this big run up, that blue line, all the way up here from the 4th of July. And we've actually dipped down to right about here. This green line, this dotted green line, that's where today's volume levels are. So we've dropped down a bit. Now that's normal. Don't freak out and say, okay, you know, the market's finally dropping, the rug's pull, all that stuff. No. If we look back here, if you can see the green and orange line are 2018 and 2019 tendered volume. So you can see that they dipped right around the same time. That's Labor Day in 2018 and 2019, and then they're down for a few days and then they recover back up. Now we're seeing it a lot later because Labor Day was later than it was in previous years, but I mean, right here we see 4th of July, Memorial Day, we'll see another one around Thanksgiving, Christmas.
Right.
So
and this valley usually takes about 5 days to actually recover. And so we'll see, you know, obviously there was a pull forward in last week, so a lot of people really pulled some of their freight that they wanted to get off their warehouse floors. And so this week usually tends to be a little bit softer of a week until getting back to online to where everyone is next week, which is kind of what we've seen over the past couple of years, which is why Luke brings this up every time we're on this show, because it just shows you what seasonality does. So you can see all those valleys are really indicative of holiday weekends. So you got 4th of July there, you got Labor Day here, you have Memorial Day, and look out into the future, you got Thanksgiving and Christmas. So things that you can just easily predict. But what we can't predict now is the rocket ship that volumes are on. And so not only have we continued to see rate per miles increase across the board, it is really a stressful time out in this industry, just because, you know, carriers, you should be having a ball right now. Rate per miles are just
it's going well. I mean, I think it's not even just that rates are high, although that's very attractive as well. They have options. Right. There's a lot of volume out there, so they just have options. And with rejection levels so high, I'm going to flip over to this chart now. If you see that 26, and let me zoom out just a little bit. There we go. That 26 in the top right-hand corner of the screen right here. That's today's tender rejection rate. So we're about 26.25%. So still pushing higher even through the Labor Day holiday.
Right.
That's causing a lot of that contracted freight to show up on spot markets that a lot of these smaller carriers haven't seen before.
Right.
As well as giving brokers more opportunities to work some of those loads. And that's just giving them more options to have. So obviously it causes them to bump rates up, rightfully so, but it's nice to have options to choose where you want to send your trucks.
Correct. And when you're really just thinking about I mean, ultimately, what are you trying to do as a carrier? You're trying to look for the most profitable lane you can find, and really going out to that West Coast, coming back east is been
right now. That's really good.
Really been proving that it's been the most profitable lane as well. But even from some of the customs data that we're seeing coming out of LA, a lot of volume coming in. We're seeing a little bit of a dip now, but it's a really good time to be out in that LA market or Ontario market to be hauling to the East Coast. Doesn't help you if you're a broker or a shipper, though, because you try to plan or try to evaluate, okay, how do I put a rate per mile on this to quote out to my customer, and then you finally get accepted, hey, I want you to ship this for me. Well, the rate has gone up $2,000 since the last time you looked at it. So have fun with that zero margin or negative margin on that. And so that's what a lot of the brokers are going through right now. People who have really dedicated business from 2019, they're dealing with the cost of 2020.
Yeah. Well, so there's a couple things to dissect there, right? So we've seen, part of the reason why the West Coast has really popped off a lot is because there's so much volume coming out of it. And traditionally, LA and Long Beach and just Southern California as a whole has been a really good market, but in the last couple of years, it's sort of been trending downward a little bit. Nothing substantial, still a great market, not a bad market, but it hasn't been seeing the same growth that it traditionally sees, and a lot of that is due to supply chains shifting outside of China.
Right.
So as shippers shift their supply chains outside of China, we're starting to see more and more of that volume show up or being shipped to the East Coast, right? So you have the Long Beach and LA, a lot of freight's being shipped in there, and that's kind of supplying a lot of the western side of the country. But then you're also beginning to see a big increase in volume or imports coming into Savannah as well as New York.
Yeah, I was going to say New York has same thing with LA,
right,
just record highs coming out of both corners of the United States.
But what's happened is since coronavirus has hit, there's been like this onslaught, a ton of volume's been ordered. We've had to resupply warehouses and stock and this whole shift. And that's causing customers or shippers to push more freight through the West Coast because it's faster to do that than to ship through the canal and then go to the East Coast.
Well, time is money right now, so
Yeah.
it's either get your products on the shelf or miss out on the opportunity.
Get them in the port, truck it across the country.
And so what we're seeing across the board, really, especially from the shipper sentiment that we talk to every day with, is they're having to bypass their DC network. And so when you're having to bypass your DC network, you're having to utilize more spot market, which for them, it's not really spot market. It's they have their carriers that they've been using on their route guides. They're just going to send those out.
It's an internal spot market. They're not posting these on a public load board.
Yeah, on one of the load boards.
It's an internal spot market, right?
Yeah, and so with that, they are seeing increased rate per miles, and so that's kind of something that we wanted to hit on today, which is those the concepts of a mini bid.
Yeah.
And we really feel like that's going to be something that's going to be prevalent in the marketplace. If it's not already, it's going to continue to be prevalent in the next couple of months, because we do kind of predict a softening effect as we get towards the end of the year.
Yeah.
But we could be completely wrong. We could see really this upward trend because of retail season kind of being prolonged. No Black Friday event, so now we're having to really prepare. But what are some of the benefits that you see from a mini bid for both carriers and shippers?
Well, Adam Robinson here at FreightWaves, he wrote a fantastic post on the FreightWaves SONAR blog yesterday that covered this. So there's a lot of benefits to actually come. So traditionally, the way shippers think about freight is, okay, we're expecting X amount of revenue, X amount of orders, right? That's going to be translated into X amount of truckloads. We know what we did last year. All right, I'm oversimplifying it here, but that's sort of how they think about it. Okay, great, let's secure that capacity. Here's our budget to move all that. Let's see if we can contract our carriers, get our routing guides set up, right? Here's who we used last year. Here's some new blood that might be good to check out, right? So they basically set up their routing guide. They go through this whole RFP process. It takes a really long time to do. They pour a ton of time into it. And then they set it up and
hope it works.
Hope it works, right? Hope they don't go over budget, right? Hopefully they don't have hardly any rejections, right? And their carrier base can just take care of it.
Let's hope a hurricane doesn't come through.
In theory, it's great because it's just like, hey, I've set up the work for the year. I'm done. I can sit back and just kind of, handle any fires that, just kind of make sure it all stays together. The problem is when the supply chains are shifting, the world's becoming more volatile. We've seen in the last 2 years, in the last 3 years, we've seen two of the most volatile freight market years ever, right? Well, you could even say 3 out of the last 4, because the end of 2017 was quite volatile. 2018 was a whole nother beast in and of itself. Then we went complete opposite side of the podium, and we went all the way down in 2019, very soft year. And then this year is just like, I don't even know what this year is.
You have experience in the freight market. Well, have fun with this.
Yeah.
Here's something that no one's ever seen.
Please tell me how your experience over the last 20 years is going to help you determine what's going to happen right now.
Yeah, I've been loving the 2020 memes that show what my normal thought process, and then what 2020's reaction to it. And it's like, really optimistic about the freight market right now. 2020, here's a hurricane for you.
Yeah. So like COVID hits the beginning of the year, right? Then, volumes reach record highs and are continuing to push highs. Then we have hurricanes. I mean, it's just like, and then online shopping hits record highs. Like we're seeing online orders and consumers, which are going to drive volume.
Right.
Those are hitting record highs. We're continuing to see that e-commerce push higher and higher and higher.
Right.
There's a reason it's not just Amazon's that's having record, orders. Walmart is having record orders, Target's having record orders, all online, right? And that just changes the way they have to ship goods.
Right, and it's making constraints across the board on all modes. I was talking to a broker that really plays in all modes, right? They do a lot of LTL, they do a lot of truckload, they do a lot on the rail. And so what they are seeing is not only is the trucking market extremely tight, but is officially, it always takes forever for it to hit some of these other modes sometimes. LTL is starting to have service failures as well now because so many people are tired of this that they're just going to be breaking it up. I mean, as normally, when you have these really constrictions on capacity, what usually happens if I try to keep the same budget is I'm going to break this bad boy up into a couple volumes, or maybe go a couple pallets at a time, throw it on the LTL network to try to protect my my overhead. And so what's happening now? We're now seeing service failures in the LTL networks. We're now seeing really no capacity for weeks on the rail network.
Yeah. And I think this all comes back to, you know, this unprecedented level of volatility. Let's bring it back to the mini bid area here. And these mini bids are kind of like a middle ground for shippers and carriers, right? The shippers want to have
almost.
Exactly. Here's my annual bid, just take it and move on. If you don't want to take it, bye, don't come see me next year, right? Or market's really low, let's push everything into the spot market, and then you have carriers running at super unprofitable rates for extended period of time. A lot of them go out of business. We saw that after the March peak, right? Rates dropped and carriers were running unprofitably for at least a month. Right. Some more than that, and that hurt a lot of them. And this mini bid process allows shippers to basically take advantage of that volatility. It essentially says, okay, the market is soft right now. Rather than pushing everything on the spot market, why don't we just do a mini bid for the next 3 months so we can lower rates, take advantage of that. But it still helps carriers to secure some of that freight, so that they're not constantly bidding against each other and it's a race to the bottom.
Yeah, it's almost, I mean, just like with shippers, what do they really, that's why they do these long-term bids. It's easy to project their cost. It's easy to really, from a leadership, what's their goal? Their goal is to get as much of their product on the shelves purchased as possible. And so transportation may not exactly be their, really their niche, obviously, because that's not what they're in business to do. That's why they're not a carrier or a brokerage. And so, you know, what they want to do is, how can I figure out how to really put a ceiling on this? And so the mini bid for a shipper is, you know, really, what is a mini bid? It's a short-term bid. It's, you know, maybe people are used to doing long-term annual bids. So these are like 3 months, 6 months, short-term bids to try to protect the amount of spend that you potentially are gonna have into the future. And so that is pretty good, especially when we're in a market like this. If you're able to negotiate, hey, I'm gonna give you a higher rate per mile because of market conditions, as long as you can secure this for the next 3 months.
Yeah.
But what is the downside to that? God forbid we have a softening effect. Now you're overpaying for transportation, so that's the risk of, you know, if I would have waited another month, I could have potentially had lowered transportation costs. But also for carriers, it's a really good hedge because rate per miles can go higher and you could potentially lose out. But if you do a mini bid right now and it does get soft, you're almost protected. You're protecting that loss. So you're really keeping the same momentum that you were having, and then rates are going down. Well, you're still, you know, going at the same rate, and it's going to take the shipper to either, you know, put out another bid, which could take weeks or months to do, or, you know, they just ride that to the end of that contract, and then you just renegotiate then.
No, absolutely. I think that's spot on, and it actually made me think of, you know, it's kind of like dollar cost averaging in the stock market, right?
Yeah.
So if, let's say we bid certain freight, let's say I'm a shipper and I'm like, okay, the market seems to be going down a little bit. Let's lock in a mini bid for the next 3 months. Well, maybe you only do it with, say, half of your freight and you leave your other freight with the annual numbers. And then the market continues to soften. Okay, great. Well, now it's softened more. Let's take advantage of that. So let's put another 25% of freight in that mini bid. And now we've kind of hit another ground, kind of just so on and so forth.
Wow, you're like creating options here.
You got, is that too much?
Yeah,
that's not really a thing. That's not a thing yet.
What do they keep saying? Keep buying on the dip. Don't just buy and then just sit. You got to keep buying. Yeah. No, that makes so much sense, and I never even thought of it like that. And so
neither did I until just now.
Right. So what I would do is almost
leave us a comment below, somebody, Shirley, please. You know, just let us know. Is that something that, you know, that you've experienced before? Is that something that's already happening? You know, this idea of like this continuous buying process to, you know, do shippers do this sort of thing where they lower rates a little bit? Or maybe it's opposite for the carriers, right?
Right.
Maybe it's, you know, as more freight goes to the spot market, they increase rates on a certain amount of capacity. The market continues to tighten up. They try to buy more, a little bit more at that next level. Maybe it works both ways.
Yeah, and you know, even to further that point a little bit more, I think we could actually throw, how I would do it if I was a shipper is throw my lanes into lane scorecard.
Yeah.
And then look at that lane score, and then from there, that will help me identify which lanes, maybe which 25% I would put onto a mini bid, maybe things that are a little bit more risky, you know, those very difficult lanes to cover. And then, as things change throughout the year, because those easy lanes that we're able to really identify on Lane Scorecard, and Luke's kind of getting this prepared for us. If just a little refresher, Lane Scorecard is an application we have within SONAR, in case you didn't see it behind me, that you can put a CSV file of your OD pairs, and then what we do is take those lanes and take our science, our data, and give you the identifiers of, or the signals of, how rates are changing.
Here, let's just do it. Let's just do it right here so everybody can see. All right, so let's throw my screen up for everybody to see. We'll walk them through real quick. All right, so here we are. So click the upload feature, select file. Very simple. I mean, this is so easy. Everybody can do this, right? This is a predetermined list that I've already made. Just a couple of random lanes. Boom, click the button, and that's it. We're done. It was that fast. It's that fast.
Yeah, go get you a coffee now. You did your work for the day.
All right, I'm done. And I'm going to zoom in a little bit so it's a little easier to see. And then if I want to, if I don't want to do it in here, I can just download this into an Excel sheet and then just kind of, slice and dice it.
If you're an Excel wizard and really like to do that, that's...
Well, maybe I need to submit this bit. Maybe I have the information in here. Okay, great. Let me download it into my own CSV. Now I can submit that in whatever format I see fit.
Right.
And I don't have to copy anything.
That makes so much sense.
Yeah, walk us through this, Kyle. What are we looking at here? So let's just use, I don't know, LA to Portland. That's the top lane in here.
Yeah, and so what this does is, across the board, we first identify what the market is. So we take those lanes that you put in, and then we identify the market that it's in, and then we go into our predictive rating tool, which shows you, depending on the time series you select, which is in that top right corner.
So we're looking at 12 months right now. But since we were talking mini bids, let's do 3 months.
Correct.
Let's click a 3-month time period.
And so what it does, it shows you how rates have changed in the past. So that first green line is going to show you what is the change that has occurred in the past 3 months. And then the next rate is going to tell you how are rates predicting to change in the future.
Right. So in this particular example, LA to Portland, we're saying that and this is since today, since I ran the report today.
Yep.
3 months ago from today, so over the last 90 days approximately, we've seen a little over 6.5% decrease in rates from LA to Portland. But we're predicting that there's going to be almost a 1.5% increase in pricing from 3 months out from today.
Yes.
Is that right?
Yep. No, that's right. You also got to think, what time period we're thinking about. 3 months out, some people are like, well, that makes no sense. We also take into effect some seasonality. We do have, Portland, what are they really known for, especially as we get closer to Christmas? You have the Christmas trees, you have different seasonal freight that comes out of there as well, so that definitely changes that. But then from there, we really give you those identifiers of percentage change, because we always know that people's pricing are very unique to their individual supply chain. And so the percentage base really allows them to identify, okay, well, how much is my freight predicting to go up? And so that's why that's used so well. And then from there, we have a couple, really other identifiers, mileage, we have duration, we have trailer type, and then we get into really a couple of the key metrics.
These are my favorite.
Yeah, I mean, really, it's the two of the most impactful indexes, and not even indexes, but really tools that people can use no matter who they are.
Yeah.
And so these alone can help you save time and money, as we like to refer to on this show.
I mean, if you're not here to make money, I don't know why you're here, because we're not that entertaining.
Yeah, if you're watching this, you're here to try to gather something, because you don't know what's going on in that market. And so volatility really tells you how volatile is the price over the next time series that you're looking at.
Let's take a minute to pause here for just a minute. So what we're saying, so everything up to this point is information that everybody's used to, right? Whenever people work on bids or pricing, it's all about what's the price. That's like one of the worst questions you can ask. I mean, like if we look at LA to Portland, right? And let's say somebody's running that lane at $2 a mile, somebody's running it at $4 a mile, right? And everything in between. That's not helpful, right? We could say the average rate is $3 a mile, but that doesn't tell me how it moves. And is it always like that? Does it fluctuate? Sometimes it's $4.50 a mile, sometimes it's $1.50 a mile.
Exactly. And I mean, what I like to refer to is that the rate per mile does not cause capacity crunch. It's that capacity crunch that causes the change in rate per mile.
100%.
So really rate is just the product of the equation being supply and demand and sentiment in the market. And so 3 things that we can provide you here that no one else can provide you.
Right.
Proprietary data to FreightWaves.
So this volatility score, it's got a score of 30. What does that mean? What do I do with that?
Yeah, so that just tells me that it's it's a scale of 1 to 100.
1 to 100.
So really, in my eyes, really it's less than 50, above 50. So less than 50 is.
So we're below 50 at 30.
Yeah, so we really are looking at less volatility, and really it's almost like a confidency of how much our rates going to be changing. So those up and down movements on that lane. So that's what that score will tell you. The closer you get to 50, I mean that'll really tell me that I should be locking in rates because there's so much volatility occurring there.
So on LA to Portland, I could probably go in with fairly good confidence, since it's 30, it's in the bottom third.
Right.
That there's not going to be too much price volatility, so I should feel confident about my rate and that it shouldn't change too much.
Correct. But just like with anything that we show here,
and this is just for the next 3 months. That's what we're talking about here.
And so it's just for the next 3 months. And so, but one data set does not rule them all. So just because rates aren't going to be changing up and down as much in the next 3 months, it doesn't mean a carrier is going to want to go there.
Yeah.
Which is why we go into the next data set, which is the lane score.
Right.
My favorite really data set in this entire platform.
You seem pretty jazzed
Dude,
about it.
I am jacked up about this thing. You have no idea because
you're right. I don't have any idea because I've never seen this before in my life.
Where did this guy? Did Kyle just leave his seat and someone else come in because a burst of energy just came through? But so what this does is it takes all of that great data sets that we have, the inbound, outbound volumes, looks at the tender rejections, look at all that data, and it gives you a composite score of how attractive is this lane to a carrier. So we told you how much price is looking to fluctuate over the next time series, 3 months. What this next data set tells you is how attractive is it to a carrier, which is extremely important.
Yeah. So this is a score of 36. So is that on the same 1 to 100 scale?
36. So it's on a scale of 1 to 36.
So it's on a scale of 1 to 36. This is the highest it can be.
And so 36
LA
is
to Portland.
the most unattractive of the score.
Okay.
1 being extremely attractive, 30. So if you were to flip that to Portland to LA, it would probably be a very low score because that's very attractive.
So what this is basically telling me, so LA to Portland, carriers do not want to take those loads. That lane is very unattractive, meaning they probably have a lot of other much better options going out of LA. So why would they want to go to Portland?
Correct.
And that's just for these next 3 months. If I change the timeline, that number may change.
Correct. No, exactly. You can
let's change it to 6 months real quick. Let's change it to 9 months. So so what's interesting is the lane score hasn't changed, but the volatility score has changed.
Mm-hmm. Yeah, and you'll notice the percentages changed as well.
Yeah, percentage has changed as well. Interesting.
Yeah.
All right, awesome. Let's skip over the origin and destination signals. We won't focus too much on there just for the sake of time. But then, of course, we get some of the basic stuff here. The current rate, right? That's a solid benchmark rate, and then, of course, the forecasted rate for the next 3 months.
Right.
And these are just line haul. Don't include fuel surcharge, correct?
Correct. No fuel surcharge, no accessorials.
Okay, got it. So let's summarize this real quick. I know we're getting towards the end of time here. But basically what this is telling me is it's telling me not just pricing and price volatility and change, but it's really giving me the market data on the lane. So if I'm a shipper or a broker, I can know, okay, what's been the historical change in pricing? Have I seen that? Have I been able to take advantage of that? Am I with the market? What's the predicted change? Is that a good predicted change for me I want to take advantage, or is it something I want to try to protect myself from? And then the volatility of the lane. How can I take advantage of that, or how can I protect myself from being vulnerable to that? And then, of course, lane score, maybe helping to secure capacity. Because if I have a score of 36, that should tell me that potentially
I need to secure
I might need a lot of capacity secured before I go into this.
Might not want to throw that on the spot market.
Yeah. Or I'm probably going to be paying a lot.
Yeah, no, exactly. So back to those mini bids, this just helps you identify which lanes you should be looking at, which ones you can maybe not
It's like the
about.
ultimate planning tool, really.
Correct.
Right? And it allows you, I mean, it saves so much time doing it. I mean, I did a click of a button and then boom, here we go. If you want to do this for 200 lanes, you could do that.
Magic Luke over here,
Yeah.
just wheeling and dealing.
I just click buttons, man.
Yeah,
Just clicking buttons. Awesome. Anyway, folks, we're getting here towards the end of time. Thank you so much for tuning in, and of course, pleasure. Thank you, Kyle, for joining me. This is a great conversation on some of the mini bid process that we're really starting to see increases for. Leave us a comment below. Unfortunately, we won't be able to answer your questions during the show today, so apologies for that. But hopefully, you enjoyed the show. Leave us a comment of what your thoughts were on all this and what you're seeing. And in the meantime, have a fantastic rest of your day.